Something just changed in XRP that matters more than it looks. The regulatory environment around crypto in the United States is shifting faster than most people realize. And the Clarity Act is now at the center of a decision that could reshape how digital assets are treated inside global financial systems. But what happens next depends on one resolved issue in Washington that's still holding everything up. Over 200 organizations are now pressing the U.S. Senate to move the Clarity Act forward, including major crypto infrastructure players and exchanges. At the same time, lawmakers are stuck negotiating key differences between committee drafts, especially around stablecoin yield rules and banking protections. Now, here's what most people miss. This isn't just about crypto regulation. It's about who controls liquidity in the next financial cycle. Banks are warning that yield-bearing stablecoins could shift deposits away from traditional systems. But industry data suggests something different is already happening. Both systems are expanding at the same time. And as political pressure builds before the July legislative window closes, the outcome of this bill could determine whether the U.S. leads the next phase of digital finance or reacts to it after it's already moved elsewhere. The United States is now facing one of the most important financial policy decisions in modern history. The Clarity Act is designed to create a clear legal framework for digital assets, something the industry has lacked for over a decade. But clarity in Washington is never simple. A coalition of over 200 organizations, including major players like Ripple, Coinbase, Solana Foundation, and Uniswap, Binance, has formally urged Senate leadership to advance the bill. The argument is straightforward. Without regulatory clarity, innovation leaves the United States. But here's where it gets interesting. Inside Washington, clarity is not defined the same way by everyone. Quick disclaimer, this content is for educational, informational, and entertainment purposes only, not financial advice. With that said, let's continue. At the center of the debate is one structural fear: liquidity migration. Traditional banks argue that stablecoin yields could pull deposits away from institutions like JP Morgan Chase. Executives such as Jamie Dimon have expressed concern that this could weaken lending capacity across the banking system. But industry analysts counter this view. They point out that stablecoin growth has not reduced bank deposits. Both systems have expanded simultaneously. Now, this is what most people miss. This is not a technology debate. It is a financial architecture debate about where money lives in the digital economy. And Senator Cynthia Lummis has repeatedly emphasized that this evolution does not represent collapse, but transition. The Clarity Act is currently moving through reconciliation between Senate committees, particularly banking and agriculture. A key amendment introduced through the Genius Act revision by Senator Bill Hagerty has added further technical complexity. Originally, a vote before the July 4th recess was considered possible. Now the more realistic timeline is after July 13th to advance to the floor. The bill requires 60 Senate votes to invoke cloture. That makes this not just a legislation, but a high-friction political threshold event. If you're enjoying breakdowns like this, make sure to like, share, and subscribe to the channel. It helps us out a lot. Now, with that said, let's continue, because the next part is where it gets more important. To understand what's happening, we need to zoom out. In 1933, the United States passed the Glass-Steagall Act during the Great Depression. It separated commercial banking from investment banking to stabilize the financial system. But it also reshaped capital markets for decades. Now compare that to today. The Clarity Act is attempting to define separation lines in a new system. Digital assets, tokenized value, and decentralized finance. But here's where it gets interesting. In both cases, lawmakers are not just responding to markets. They are defining the structure of future markets. See, while Washington debates, other jurisdictions are moving faster. South Korea, parts of Europe, and emerging financial hubs are already deploying structured frameworks for digital assets. This creates a jurisdictional pressure effect. Capital does not wait for uncertainty. On June 7th, over 200 organizations signed a letter urging Senate leadership to act before momentum is lost. Signatories included industry coalitions such as Blockchain Association, Crypto Council for Innovation, Digital Chamber, Stand with Crypto. Now, this is what most people miss. This is not lobbying, it's regulatory competition between nations. Analysts like Matt Hogan suggest that post-Clarity Act environment will not resemble previous crypto cycles. Instead of speculation-driven growth, the focus shifts towards stablecoins, tokenized real-world assets, compliance-first blockchain infrastructure. This positions infrastructure networks like XRP, XLM, and Chainlink as potential beneficiaries of regulated financial integration. Because in financial history, speculation dominates uncertainty, but infrastructure dominates clarity. Think about the early railroad expansions in the 19th century. At first, rail systems developed independently with no unified standards. Chaos, inefficiency, and fragmented growth defined the sector. Then governments intervened and introduced standardization. That moment transferred rail from speculation-driven expansion into industrial backbone infrastructure. Now compare that to crypto today. We are still in the fragmented expansion phase. The Clarity Act represents the standardization phase. Ladies and gentlemen, one of the most complex issues in the bill is how to regulate decentralized finance. Lawmakers are attempting to balance innovation, freedom, systematic financial safety, enforcement clarity. But here's the challenge. DeFi does not operate with traditional legal structure. It operates as programmable liquidity. And that makes regulatory transition extremely difficult. Ladies and gentlemen, in 1944, the Bretton Woods Agreement established the post-war global financial order. It created institutions like the IMF and World Bank, reshaping global monetary coordination for decades. Now compare that to today. The Clarity Act is not just domestic policy. It could become a foundational reference point for global digital asset regulation. History shows a pattern. When financial systems reset, they don't evolve incrementally. They reorganize structurally. In the early internet era, governments struggled to regulate digital communication systems. By the time regulatory frameworks emerged, the dominant platforms had already been established. That delay created long-term market concentration effects. Now the parallel is clear. Crypto today is in its formative governance phase, and whoever defines the rules shapes the winners. Think about the risk of delay. If the Clarity Act is delayed, analysts warn of prolonged uncertainty in capital markets. This could lead to fragmented liquidity, slower institutional entry, migration of innovation offshore. And while the United States debates, other regions continue building infrastructure. That is not just delay, that is structural, positioning losses. The capital rotation phase. But here's where it gets even more important. Once regulatory clarity is established, markets do not gradually adjust. They reallocate. Institutional investors, including pension funds and sovereign wealth entities, do not react emotionally. They reposition strategically. This creates a second phase, not speculation, but structural inflow. And by the time retail participants notice, positioning is already complete. This is the $10 trillion question. Some long-range projects suggest crypto markets could expand into the multi-trillion-dollar range by 2030. Estimates vary between $5 trillion and $15 trillion. But this outcome depends on one variable, regulatory certainty, because capital does not scale on narrative alone. It scales on enforceable structure. So here's the final system view. Zoom out for a second. This is no longer about one piece of legislation. It's about three forces colliding: innovation, philosophy, regulatory architecture, global competition. And all three are converging at once. Price reacts, but systems evolves. See, the Clarity Act may become one of the most defining financial turning points of this decade, not because it immediately transforms markets, but because it defines a framework that future markets will operate within and in that structure. Winners and losers are decided long before price reflects it. The only question left is who adopts it first. If you found value in this breakdown, subscribe for more institutional-grade financial analysts, because the goal is not to follow narratives, it's to understand the systems operating them. The liquidity follows, the infrastructure layers, and the institutional positioning shaping the next phase of digital finance. The transformation is not coming. It's being built in real time. That's why I always tell you got to pay attention to what's quiet, ladies and gentlemen. I hope everyone's having a great day today, ladies and gentlemen. Market's really telling us a lot. Really. I want to welcome all the new members of the Patreon, all the new members of the membership channel. If you look at what's been going on here right now, it tells a tale. If anybody who's been listening to the free content on this channel and has been writing down, taking notes, and taking actionable intelligence, I salute you. You look at where gold is, it's broken below. Silver's broken below. Platinum, palladium's broken below. We told you for many, many videos that we were bearish on gold and silver and other metals. Well, the metals were a few hundred points higher. None of this is financial advice, just my opinion, and anyone who attends any capacity. We're going to be traveling to meet with clients and family offices who have retained our services and with existing customers that are very happy. See, when you risk everything and you're ahead of the curve, it's very fulfilling. It really, really is. But the market now is in a new phase. It's looking for different things. One thing you have to really pay attention to is CPI reports. And this is one number that you should obsess over. One monthly inflation print, one headline that will determine financial media for the next 48 hours. And once again, the market's asking the wrong question. Markets normally ask the wrong question because it's reacting. The question is not whether inflation is falling. The question is, which inflation are we talking about? Because what we're seeing right now is something far more complicated than a simple inflation decline. Inflation isn't disappearing. It's splitting into two completely different realities. And if you don't understand that distinction, you're probably going to get chopped up like sushi, and you're going to misunderstand what happens next in stocks, bonds, energy, gold, interest rates. The AI boom is fueling inflation. That's not going away anytime soon because commodities are being sucked out of the ground and purposed to build these data centers. That's not going to stop anytime soon. Let's start with the inflation everyone watches, the official version. Heading into this report, economists at Goldman Sachs expect core CPI to rise just 17%. Just 0.17% month over month. JP Morgan came in slightly higher, 0.27%. Either way, we're talking about annual core inflation somewhere between 2.8% to 2.9%. So on paper, that's pretty good. But that's not runaway inflation. That's not a crisis. That's not the type of number that would normally justify panic. In fact, you only looked at the CPI data, you might conclude that the Federal Reserve is winning. You might conclude inflation steadily moving back towards target. You might conclude rate cuts are eventually coming. And that's exactly why this conversation is becoming so dangerous. Because the inflation showing up in official statistics is no longer telling the entire story. I keep saying you got to go back and look at the AI data war, the kilowatt war. This skews everything. It does. And then you throw in the jobs number, skews everything even more. Death by 1,000 headlines, death by 1,000 tweets. If you look around the economy, do things feel like inflation is disappearing? Energy prices remain elevated. Insurance costs continue climbing. Healthcare costs continue rising. Construction costs remain stubbornly high. Labor remains expensive. Utility bills are rising. And meanwhile, some of the largest capital spending programs in modern economic history are happening right in front of us. This is where the story becomes interesting. See, Goldman made an observation that I think is one of the most important comments made all year. They essentially asked, if inflation's cooling, why do inflationary conditions still feel so widespread? That's the right question, because underneath the CPI data, something much big is happening. The United States economy is transforming. See, for years, growth was primarily consumption-driven. People consumed. Consumers bought things. Consumers borrowed money. Consumers drove economic activity. Today, increasingly, growth is being driven by investment, massive investment, not millions, not billions, trillions. Artificial intelligence infrastructure, semiconductor, manufacturing, data centers, power generation, electric grid upgrades, transmission networks, defense spending, industrial reshoring, strategic manufacturing, energy infrastructure. The amount of capital is being deployed right now is extraordinary. Here's the part most people miss. Investment spending creates demand just like consumer spending does. Actually, in many cases, it creates even more demand. Think about what it takes to build a hyperscale AI data center. You need land, concrete, steel, copper, transformers. You need cooling systems. You need electrical equipment. You need highly skilled labor. You need engineers. You need energy. Not multiply that across hundreds of projects happening simultaneously. Then they had semiconductor fabs. Then they had grid monetization. Then they had defense manufacturing. Then add energy infrastructure. Suddenly you have an economy where inflation pressure is no longer primarily coming from consumers buying too many televisions. It's coming from a race to build a future. That changes everything because traditional inflation models were built around consumption cycles. The inflation we're seeing today increasingly resembles investment cycle inflation. And those are two very different animals. This helps explain why one of the strangest market divergences right now. Financial markets keep signaling that inflation should moderate, but it's not going to. You hear every day the AI race. When you hear the AI race, I want you to think of inflation, okay? Because the real economy keeps refusing to cooperate. Think inflation when you hear AI. See, Goldman highlighted this gap directly. Market-based inflation. Expectations have normalized significantly. What I just said is so important. You need to tattoo that somewhere where you're not going to forget it. Not literally, but mentally. The U.S. is not consumer-driven inflation anymore. It's construction inflation. We're at war. I've been saying this on so many videos. I don't know how to bring this to you. It's going to affect everything. It's going to. See, if you look at macroeconomic inflation indicators, they remain elevated. Translation, taking the PhD out of PhD, investors are pricing one future. The real economy is experiencing another. And whenever that gap becomes large enough, something eventually has to adjust. Either inflation falls much faster than expected or markets have to reprice. Now let's talk about why the CPA report matters so much. Because right now, markets are behaving like inflation is the only variable that matters. Look at how trading desks are framing this release. JP Morgan scenario. Analysts suggest that if core CPI comes in above roughly 0.35, month over month, the S&P 500 could lose between 2 and 3%. One inflation print, a potential multi-trillion-dollar swing in the market capitalization. On the other hand, if core CPI lands below 0.20, equities could rally sharply. That tells you everything you need to know. Markets are not trading fundamentals. Markets are trading inflation expectations. Every earnings report, every valuation model, every growth projection, every bond yield, every risk asset, everything ultimately funnels back into one question. What happens to inflation? And that creates a problem. Of course, the inflation data may be understanding the actual inflationary environment. Let me explain this. Imagine an economy where productivity or growth remains mediocre. Capital spending explodes. Okay? Governments run deficits of 6 to 7% of GDP. Corporations invest hundreds of billions in infrastructure. Energy demand rises, labor demand rises, commodity demand rises. And that environment, CPI might cool temporarily. But underlying inflation pressure never truly disappears. It's simply moving locations. Instead of showing up in consumer goods, it shows up in assets. Instead of showing up in television, it shows up in electricity. Instead of showing up in clothing, it shows up in construction materials. Instead of showing up in groceries, it shows up in industrial capacity. The inflation hasn't vanished, ladies and gentlemen. It has migrated. And that's why so many investors feel confused. The official numbers keep improving, yet the economy still feels expensive because both observations can be true at the same time. Now, here's where things become especially important. Write this down. The Federal Reserve has tools to slow consumer demand. Interest rates work reasonably well when households are driving inflation. But what happens when strategic investments driving inflation? What happens when governments want more factories? What happens when corporations want more AI infrastructure? What happens when national security priorities require more manufacturing capacity? The Fed cannot simply raise rates and convince policymakers to stop reassuring supply chains. Can't. The Fed cannot raise rates and convince technology companies to stop competing in the AI race. The Fed cannot raise rates and eliminate strategic infrastructure investments. Those forces exist outside the traditional monetary policy framework. That means inflation could prove much more persistent than many investors expect, not because consumers are overheating, but because capital allocation is overheating. That's a very different problem, and it's one financial markets may not be fully prepared for. None of this means inflation is about to explode higher tomorrow. That's not the argument. The argument is that investors may be focusing too heavily on monthly CPI fluctuations while ignoring the structural forces building beneath the surface. See, the economy is changing. The drivers of growth are changing. The drivers of inflation are changing. And the models that worked during the last decade may not work during the next one. That's the biggest risk and necessary that inflation spikes. The biggest risk is that inflation remains sticky enough to keep interest rates structurally higher than markets currently expect. That would affect everything. Stocks, bonds, real estate, private equity, venture capital, gold, the dollar, everything. And that is why this CPI report matters. Not because of 1 month data, but because it provides another clue into a much larger puzzle. The market's trying to determine whether inflation is actually being defeated or whether inflation is simply evolving into another form that traditional measurements struggle to capture. The distinction may define the next several years of investing, and it may ultimately determine who understands the cycle and who gets blindsided by it. That's the biggest thing, ladies and gentlemen. I've been on the phones nonstop with clientele and family offices. The fact that we are so heavily involved in commodities, always have been since 15 years old, and that we run concessions, that we run our own refineries. We see the demand that's coming because we get calls every day for everything that can be produced and sucked out of the ground and sourced, every offtake agreement. I don't expect most people to quite understand this or fathom this. You'd have to go back 20 years to see another commodity cycle like this. But this one is unlike anything I have ever witnessed myself or heard in my entire financial career. Because what's driving inflation is a new type of Cold War activity, an AI battle. It's got nothing to do with consumer spending. If you take one thing from today's video that I just said, it's got nothing anymore to do with consumer spending. I know what I just said sounds a lot like watching paint dry on the wall, but you got to understand this is going to determine who's successful, who gets chopped up like sushi, who treads water, who sinks. Look at the metals markets right now. See, we saw it first happening in platinum and palladium. Being financial mercenaries, we can see what's going to happen before Main Street does. Operating 24 hours a day, we see it faster. It's just what we do. We're in a commodity bull cycle now. It's being sucked up because of AI, Cold War situation. I don't expect most people to understand this. I expect most people to get cut up like sushi. And I expect them to be exit liquidity for our positions. I make no bones about it. I once told everybody here that most of the people that we work for don't like me. They like my methods and tactics, our methods and tactics, because it produces results. When you work for certain people, you're not supposed to like them. You like the life that they afford you by working for them. Okay? And at the end of the day, this whole situation is going to shock the world. Shock the world. If you're here listening to these videos and you make it to the candy of the Italian ice, you'll be prepared because you're going to hear what we're talking about. Why? If you're in the Crypto Republic Desk monthly inside of our Patreon, you're going to see the plays and positions, price points, limits, everything that we're going and taking advantage of and why. You'll be on our Sunday Zoom calls that are live, going over what we're going to do and why. Make no bones about it. What I'm talking about right now is so boring, I doubt we're going to get any views on this video. It's so boring. But this is the recipe for success. This is it. Inflation is driven now by the consumption of commodities because of the AI Cold War. It's got nothing to do with consumer spending anymore. Those reports mean ungats. Nothing. You could wipe your butt with them and throw them out. Doesn't matter anymore because the Fed can't raise rates and stop what I just said. It's not going to stop China doing what they're going to do. It's not going to stop the AI war. It's not. It's not like the old adage of, oh my God, there's too much money chasing too little goods. Everybody's buying washers and dryers. There's not enough washers and dryers. They go higher. You want people to stop buying washers and dryers? What do? You raise interest rates. People park their money in a bank. They stop spending. Inflation goes the opposite way when you do that. You can't stop the government from spending to win the AI war. Doesn't matter how high interest rates are. They don't play in that ball game. They're playing a different sport. That's why I say we're the remora. Because we're feasting on people's stupidity. We're feasting on people's stupidity. Their greed. It's okay to be greedy, but you got to have a plan. If you got no plan, you got ungats. You got nothing. Do you understand what I'm saying? If you're still here watching, you do. That is the biggest relationship right now to worry about. So, how are you going to play this? How does one play this, right? First off, none of this is financial advice, just my own opinion and retains our organization and myself. Now, the fact that we just established what can be done, what can't be done, what the relationship is and why. You write that down, you put that on your wall. If you need be, you take the transcript from this video, print it out. Come to point 20 on. You don't lose the conviction of where you're going. We had a phone call, myself and Domenico and AJ, with a very, very powerful client, a woman. She no joke. She no joke. No joke client from a family office. No joke. She's from the family. She wants to know why we should sit in certain cryptos and plays right now and not move into certain financial instruments that she knows she's watched us double and triple our money in within, one futures contract month. My argument is simple. You can't stop what's coming. You can't stop the AI war. If the AI war is pushing inflation, it's pushing the inflation. How are you not involved in it? It's moving the inflation. And if the AI play is moving the inflation needle, you got to be exposed to it. Because in my professional opinion, that's the only thing that's not going to get cut up like sushi. ICP, XRP, H-bar, the commodities designed to fuel this because it's part of the play. It's being consumed. You'll always be able to step into a market and take advantage of a high or low, take advantage of a price abnormality, taking advantage of cultural and economic and human civilization shifts happen once in a generation. Granted, when I get like this, people record it and think it's hysterical. But it's the truth. So if you don't want to get caught up like sushi, just write down what I just said. Because people who are going to risk an entire yard like we do day in, day out, got to make hard calls. The call is not to think about what I can do, double my money in 30 days, and miss the generational wealth creation because of what I just said. Most people's attention spans are like that of a goldfish. It swims to one side of the fish tank and it forgets what the other side looked like. That's why we on their fresh sushi. On their fresh sushi. See, I say this with conviction because I've lived through the financial wars. I have my scars. That's why we work for who we work for. That's why if you found this channel, you're so lucky. You are. You really, really are. We're not designed to make hype videos. I don't know how to do that. I mean, could you imagine the algorithm trying to find like-minded videos like me? Us, please. What I just said is the truth. Do I have your attention now? I hope so. Because that's the truth. And this woman, she's no joke. Her family office and her family, no joke. Thank God she looks at us like family. But that's what we said to her. and her family and the family office running her fortune. And it makes sense because it works. See, if you don't have the novelty to have a portfolio where you're actually involved in physical concessions, okay, whether that be agricultural, metals, you're not hedged. You're playing financial instruments that are keying off of a commodity. See, working for the exchange in my family, I learned so much. God, man, all the floor traders who hit me in the head with cards, so much. This is a zero-sum game. You have someone running the Fed who now believes rates will be higher. That just poured cold water all over the markets, okay? You got kinetic action potentially going on. But ask yourself, why isn't oil spiking through the roof right now, right? Why isn't it? Higher rates crushes all asset prices. The overall prediction of higher rates crushes all asset prices. The one thing that will not be crushed is what's causing all of this, ladies and gentlemen. I just gave you the biggest free tip ever, but it's not financial advice. It's just my opinion, retains any capacity. You just heard what a massive family office heard and the family for free. So when you look at asset prices, and if you're still here, I love you all. If you hate on me, I love you. I love my haters. Give me the haterade. Comment right here. We're not crypto influencers here. We're financial mercenaries. You made it to the Crypto Republic. You are part of the wolf pack once you subscribe. You are a financial mercenary. You are learning. You want to hear the truth of what's happening, not something regurgitated that I'm going to pull up someone else's feed and show you what they said or don't. I don't care what people say. Most people are copying what I say all day. It's so funny. I don't really care. I care about being right. I care about my family eating. I care about my clientele winning. And I care about the crypto public growing. And the crypto public grows because everybody here wants to learn. You get more from a rough market than easy sailing. Sailing into the storm is what this life's about. To become a skilled mariner, you got to lose sight of land. I love you all, ladies and gentlemen. I'll see you on the front lines. None of this is financial advice. If you want to learn about what I just said and how to take advantage of it, come and join the Crypto Public Desk Monthly inside the Patreon. One tip from the pits can pay for your entire year subscription. Join over 570 people. We're going to cap the numbers soon because we can't answer everybody's questions. I love you all. I'll see you on the front lines. Don't get caught up like sushi. Have a plan. I'll see you when I get back. I love you all. Remember, pay attention to what's quiet.